Good evening. My name is Jody Blankenship. I'm the president and CEO of the Indiana Historical Society. And on behalf of the staff and board of the IHS, I want to welcome you to the Eugene and Marilyn Glick Indiana History Center. And thank you for joining us tonight. We are delighted to have you here. This year marks the 250th anniversary of the signing of the Declaration of Independence. And tonight's program officially launches our commemorations, which will continue through 2027. Throughout the year, we'll be exploring the history of the United States and the systems that sustain our democracy. Along the way, we'll celebrate the achievements of communities, commemorate the sacrifices made in the defense of democratic ideas, and help people build the skills to become their own family historians. Your support makes this work possible. It allows the Indiana Historical Society to collect and preserve Indiana's unique stories, bring Hoosiers together to remember and share the past, and inspire a future grounded in our state's shared values and principles. If you'd like to learn more about our mission and programs, our staff would be happy to talk to you about it. We're all wearing gold name tags, and there's some folks at the front table. Any of us would be happy to tell you more about the IHS and what it does. Tonight's program will feature a conversation between Dean Jim Bullard and Mr. Rafael Sanchez. They'll talk for about 45 minutes, followed by a brief Q&A with the audience. When we reach the Q&A portion, please flag down one of our staff members and they'll bring a microphone to you. Please note also that the program is being recorded and it'll be available on our YouTube channel within the next week. The conversation will conclude around 7:15, and then we'd invite you to join us back in the Welcome Center for a dessert reception. Now, it's my pleasure to introduce our speakers. Jim Bullard is the inaugural dean of the reimagined Mitch Daniels School of Business at Purdue University. A nationally respected economist and scholar leader, Dean Bullard previously served for 15 years as president and CEO of the Federal Reserve Bank of St. Louis, where he played a key role on the Federal Open Market Committee in shaping U.S. monetary policy. He's been widely recognized for his innovative thinking and leadership, and for his commitment to advancing rigorous, data-driven approaches to economic policy and business education. Interviewing Dean Bullard will be Rafael Sanchez. Rafael serves as Executive Vice President, Chief Impact Officer, and Indianapolis Market President for Old National Bank, one of the largest Indiana-based banks and a top 100 U.S. bank nationwide. He's a widely respected business and civic leader, having previously served as president and CEO of Indianapolis Power and Light. An attorney by training, Mr. Sanchez has devoted his career to strengthening institutions and communities across Indiana. In recognition for his long-standing civic engagement, he was awarded the Sagamore of the Wabash by Governor Eric Holcomb in 2017. Now, without further ado, please join me in welcoming Dean Bullard and Mr. Sanchez.
Well, good evening. Thank you for being here. Thank you, Jim, for joining us this evening. It's not cold outside. It's only cold in your head. So, but let's just kick things off, and it's okay if I call you Jim?
Absolutely.
Okay. So, really quickly for the audience, if you could tell us a little bit about your background and how you got appointed to the Federal Reserve Bank, and we'll start from there.
Well, I'm a PhD in economics from a school that cannot be named.
Not at the moment.
No, I went to IU Bloomington and had a great experience there. And then I took the job in the Fed right from graduate school. And so I've been at the Fed, or was at the Fed for a long time. I was on the research staff there. That job is very close to an academic style job. You write research papers, you get citations, you go to conferences, you have co-authors. That's the world that you live in. I also taught at Washington University in their PhD sequence there, and then I was named president in 2008. And so I was more in the policy world from 2008 to 2023, and then I took the offer to come to Purdue and run the reimagined Mitch Daniels School of Business.
By the way, a heck of a time to become president in 2008.
Yeah, I always joke that I learned all the stuff, all the Fed stuff while I was on the research staff and advised presidents and stuff. But then when I became president, all of that was out the door. You had to learn everything all over again. Yeah.
So I was looking at your CV, and I just want the audience members to see me flip pages with all your publications and your working papers, and it just keeps going on and on and on. I'm on page 17, no joke. And it just keeps going on. Page 25. And by the way, in preparation for this, I read every single one of these papers. But somewhere I read that you were ranked number 7th most influential economist. Was it in the world?
Yeah, what I love about that ranking was Paul Krugman was down the list a little bit. So
yeah. So I have so many questions. Like, first one is like, how did you let the other 6 beat you? I mean, like, well, what's up with that? But I didn't know that there was a ranking. Do you know if there's a ranking of bankers? I'm just asking for a friend.
You're number 5.
No, but it's really really fascinating to see that. But you were president for the Federal Reserve Board, St. Louis, for the St. Louis region for 15 years, which had been at that time, at least, and maybe still today, the longest serving Federal Reserve Bank president in the country. So to what do you attribute you being in that position for so long? And I know we all know now what caused you to step away, but I want to ask you a few questions about your thought process about leaving that to go be at Purdue School of Business.
Well, one of the main things is I was relatively young compared to the other people that get appointed to the Federal Reserve. So I think that was one of the key features. So I could serve for a long time as president. But a lot of people would get that position later in your sort of work life cycle, and then they would retire in the job or whatever. So so my situation was a little different from that perspective.
Okay, and then tell us about, so you're there for 15 years, and does the phone ring and it's Mitch Daniels trying to recruit you, or
That's it.
what?
It was kind of.
It was?
It was
See, I knew it.
Mitch, I had a call with Mitch. I was actually working out of Minneapolis that day, out of Minneapolis Fed, and I remember it was scheduled for 30 minutes. We talked for like 2 hours, so that was pretty much the start of it.
And what made you say yes to that?
Oh, it's so many things, but for me, it gets me closer to the academic world, which I love, the research world, which I love. So I think that's a big factor. They wanted to, obviously they're naming the school after Mitch, who has great hordes of admirers, I would say. And it's just fantastic. And that, it's something where you're trying to manage and go from good to great. And I love that. Plenty of money behind it. And so resources were going to be there. So all of that has worked out very well. And makes sense strategically for Purdue and for Indiana as a state. And so all of that sort of fit together as far as I was concerned.
Great. Do we have any Purdue alumni in the audience?
Excellent.
Sorry about your football program. But I support you, though. Yeah. Basketball? Yeah, man. But so tell us, like, with your background as an economist, and not just an economist, the 7th ranked economist, how did that shape the way maybe you approached leadership and your decision making while you were president of the Federal Reserve St. Louis?
Well, you have to be humble. And when I came into the job, I think, we all think we know things, but I had to learn a lot. And I learned a lot, especially from my first vice president, but others as well that were on the management team that had a lot of experience. And so I think that helped me enormously as I was getting into the job. And it was, you walking into a crisis basically immediately upon taking the job. So there's a lot to like about how we were able to build up the management team further and handle the crisis.
Yeah. So let's talk a little bit about sort of the history of the Federal Reserve. Maybe some folks in the audience don't know a lot about how it all got started and how it's even structured today. But what were the economic and political failures of the time that led to the creation of the Federal Reserve back in 1913?
Yeah, so the Federal Reserve is the central bank of the United States, and it has been around for more than 100 years now, but you might wonder why it has the structure that it has. There's a saying, maybe a book about the creature from Jekyll Island. That's a reference to the actual origins of the Fed. But the reason it was done there at Jekyll Island in a secretive mission was because the first two central banks of the United States failed. And in particular, the second bank of the United States was a major political issue in the time of Andrew Jackson. And he campaigned, he was a populist figure, not unlike what we have today, and thought that the bank represented Eastern interests and was ripping off people in the middle of the country like here. And it had a successful campaign to allow that charter to expire. And so the U.S. did not have a central bank from that point, pre-Civil War, through the Civil War, and all the way up to the Panic of 1907. So, that period was roiled by financial crises of various kinds, and by the time you got to the Panic of 1907, people decided, the country had grown a lot. GDP was much higher and becoming an industrial world power. And you didn't have a central bank, and that was kind of considered, it made the U.S. suspect, I think, in the eyes of European money especially, but also from elsewhere in the world. And so something had to be done. Everyone kind of threw in the towel at the Panic of 1907 and said, well, we were going to have to do something. And so they arranged this trip to Jekyll Island as supposedly as a hunting trip, but Paul Warburg was there, a famous international banker, and one of the major political figures of the day, the senator from Connecticut, if I have it right, and they kind of hatched up a plan about how they would put together a central bank for the United States. But the key things are, and that turned into the Federal Reserve Act, which is what we're still talking about today, and which still governs the central bank today. The key features were that you were going to decentralize power out across the country. You weren't just going to let everything be centralized in New York City or in Washington, D.C. So the plan and the actual implementation has three parts to it. There's a Washington, D.C. part, which is sort of the political arm. There you have 7 governors of the system. They're appointed by the president and confirmed by the Senate. But the system also set up 12 banks across the country, one of which is in New York. So you have the financial, and the New York Fed is very powerful. And they, are the connection to Wall Street and to global financial markets. But you also have a Main Street component, which is the other 11 banks, which are all out across the country. And I might also mention that all the banks have branches as well. So there's even more outreach maybe than you might think. The St. Louis Fed, for instance, has branches in Little Rock, Memphis, and Louisville, Kentucky. So quite the reach really across the country. So that system, I always say, works. It's a brilliant design actually, and it works best when all three stools all three legs of the stool work well. You have the Main Street component talking about input from places like Indiana. You've got the Wall Street component interfacing with global financial markets, and you've got a political component that's interfacing with the Congress and with the administration. So if all of the three of those play their role effectively, then I think you get pretty good monetary policy for the United States.
So I looked into this. It was in one of your many papers. I'm kidding. But you guys probably can't see this, but this is sort of the map of what Jim was just talking about how the different regions are broken up for the Federal Reserve. And what struck me in looking at it was just, if you just look at the dots, where the seat is, it looks heavily on the East Coast. And I was actually surprised that, like, for example, the 12th, which is in, where is it? San Francisco. Like it encompasses a large region. Has there been any discussion about reevaluating the 12, and are they appropriately distributed? Asking for a friend.
Before the ink was dry on the Woodrow Wilson signature, they were already debating about that. And, they had that, the act called for, it had an implementation clause in it. I guess you can still read it. And it said, here's how we're going to do it. We're going to have a commission. The commission's going to decide where to put these reserve banks. You can have up to 8 to 12. And the commission took applications from all over the country. I don't know if Indianapolis put one in or not, but probably they did. And when the commission was looking at this issue, of course, all the population's really over on the East Coast compared to today. So California wasn't California at the time. And so they put just the one bank out there, the San Francisco Fed. And now they have, California all by itself is the 5th largest economy in the world or something like that. So I think you probably wouldn't do it that way again. And Missouri famously got two banks. St. Louis was considered a foregone conclusion. St. Louis was the 4th largest city in the nation at the time, and kind of the big Western city, because the other 3 large cities were on the East Coast: Philadelphia, Boston, and New York. And so it was considered obvious that St. Louis would get it. So this is what the commission came up with. But again, you do have all these branches, so it's not like the other places are completely devoid of representation. You've got a branch in Miami, you've got a branch in Detroit, we've got a branch in Helena, Montana, you've got a branch in Seattle. So I've been to most of them, and they are a good way to get input from all over the country.
Well, I have it upon information and belief that if the Chicago Bears move to Indiana, then it'll move also with the Federal Reserve from Chicago.
No, one way you could...
It's part of the Senate.
No, it's like the Dodgers moved to L.A., so you can move the New York Fed to L.A., and then it would all be balanced again.
There you go. So we talked about structure. So the Fed's mandate has evolved over time as well. And as you know, this dual mandate, what's called the dual mandate of price stability and maximum employment. And then you add to that moderating long-term interest rates. Talk to us a little bit about those, the dual mandate and the main purposes of the Federal Reserve. What does it do?
Yeah, the mandate was really decided upon in the 70s, and it is a triple mandate. It's often described as a dual mandate. You're supposed to have stable prices, maximum employment. The third part is the moderate long-term interest rates. And so when interest rates were down at 0 from 2010 to 2019, I would always say, hey, we're nailing that third mandate.
Overachiever.
But now we're back in the world of positive nominal interest rates, so that's all gone. Well, our main rival in the world, which is the European Central Bank, actually just has a price stability mandate and nothing else by treaty. So that's probably not going to change anytime soon. What I think about this is that the practice of monetary policy, the way it's conducted and the way you look at the data and the way you make decisions, I don't think that really depends on what it says about mandates, because the only thing the central bank can do in the medium term is control the inflation rate. It can't really control the real economy or employment or any other real variable. So I think the Europeans in many ways have it right. They say, well, okay, over the medium term, 5 years or something, the only thing that the central bank is supposed to do is keep inflation low and stable. A lot of that came from the Germans. The Germans have a lot of rectitude on this issue, and they're very influential in European politics. So on the American side, you've got this dual mandate, but you should remind everybody periodically that, the Fed can't make the economy grow rapidly. They can't all of a sudden make everybody rich or anything like that. But what they can do is control the inflation rate over a medium term, like 5 years.
And speaking of controlling rates, let's talk a little bit about the FOMC, Federal Open Market Committee, which is obviously a very powerful and important committee comprised of, if I get this right, the 7 governors of the board, the president of the New York board, he or she is always a member, and then 4 other
That's right.
members, presidents of different boards on a rotating basis.
But that's for voting. For actual meetings, everybody's there.
Yeah.
So, and look at how intricate the Federal Reserve Act was. They're thinking very carefully about who's going to get to vote, and okay, there's going to be 7 governors, then there'll be 5 presidents. So if it really came down to something, the presidentially appointed people would have 7 votes. So they would have it just enough to carry the day. If they're at full strength, sometimes they weren't at full strength when I was there. They were down to 3 governors at one point. But they thought very carefully about all these issues. Also, the boards, so the banks are supposed to be like private corporations, and they have boards of directors. So I had a board. It was made up of basically movers and shakers from around the 8th Federal Reserve District, and they were great and gave me a lot of guidance and input as a CEO of the bank. But even that was considered very carefully in the act. 3 of these board members would be bankers or represent the banking industry. 3 of the board members could not be bankers and had to represent the industry or business part of the economy. And 3 of them were supposed to be sort of impartial observers appointed by the Board of Governors in Washington, D.C. So super intricate about exactly how all this is going to work. Why did they decide on that? The bankers are sort of the supply of credit. The business people are sort of the demanders of credit, and the politically appointed people supposedly are the impartial observers that are deciding between the creditors and between the borrowers and the lenders. So I think
kind of like a checks and balances.
Absolutely, and I think what they had this eye toward the idea that the previous 2 central banks of the United States had failed. How were they going to design something that would stand the test of time, even when there were crises? They had the Great Depression, had big inflation in the 70s. You had the pandemic. You had the global financial crisis. The Fed's able to weather all that because of the attention to the design of the act all these years ago. So lots of vision, I would say. I'll give a lot of credit to that generation.
Yeah. So as I understand it, that committee is the one that basically has the debate about whether to raise interest rates.
Yeah, this big 19-member group comes together 8 times a year in Washington.
But everyone's invited, like that.
Well, everyone's there at every
So-
meeting. Everyone speaks at every meeting. You wouldn't be able to tell who's voting. In fact, when I was there, I would forget who's going to be voting on that particular meeting.
So
The voting
it's obviously
kind of
good governance.
stupid, because it's always, yes, Mr. Chairman. It could be no other way, Mr. Chairman. Your wisdom is infinite, Mr. Chairman. That's basically the voting.
So, but how, I mean, I'm just trying to picture this because, as I'm sure you've heard, like you take 10 lawyers into a room and you walk away with 10 different legal opinions, like.
Yeah, well, 10 times a room, you come out with 20 opinions.
Yeah. So, like, tell us, I mean, how in the world is that effective? How does that work? Like, if everybody's talking, everybody's got an opinion.
It's a big meeting. It's a formal meeting. There's heavy pressure on pretty much every meeting. So you have to have your ducks in a row. And that's the job of the chair, is basically to formulate policy, not just for the current meeting, but the path of policy in the meetings ahead, and get people more but less online with what's going to happen. And believe me, everybody does have an opinion. They take their role very seriously, and they should. But they and the banks have their own staff, so you have your own team to analyze everything, and the board staff is also very large, and very good. So lots and lots of opinions. It's a long meeting. At least in recent years, it's been a day and a half meeting. And there's been more and more awareness all the way through my career that you're not really just deciding what's going to happen on that day. You're deciding how to shape the future path of policy over the next, let's say, 6 months to a year. And that's really what influences markets, maybe even more than what happens on the particular day. So when you vote for things, then you vote on, is it a good decision that day and what you do that day? But a lot of the discussion is really about what's the path of policy going forward. And a lot of the kind of jockeying around on the committee is well, okay, I can go for a rate cut today, but I don't think we should do anything next time or the time after that. And somebody else might feel like, I think we should do even more today, or I think we should do what we're going to do today, and we should do even more next time. So that's most of where the debate is and the jockeying.
And how much you're not under a non-disclosure agreement, are you? We're not violating anything today.
It's too
late. Okay. Because we got some lawyers in the room that can help you. But how much of the decision is, in your opinion, pre-baked? Like, you kind of know, like, and maybe the voting members have talked.
So this is what I'm saying. You can't run a meeting of that size with that kind of pressure on the meeting without basically knowing here's where we're going to do. Maybe not exactly. I would say Chair Bernanke was one that left things open a little bit, and he liked to do that because the committee could take ownership at the meeting, and they could talk about this provision or that provision. But still, it's pretty much baked out. When the committee gets in trouble, Janet didn't like to do that. By the way, Janet didn't like messing around with the language, right at the end and stuff like that. She wants everything cut and dry. But some people have a little bit different styles. But
what about Powell?
Powell also didn't really want to monkey around at the end. But when the committee gets in trouble, is you've kind of orchestrated, the chair's kind of orchestrated. Here's basically where we are. Here's what's going to happen at this meeting. Here's the language we're going to use. 90% or something like that. But then in the days right before the meeting, if you get a lot of market volatility, that usually scrambles all the calculations, and then that makes the meeting far more hectic and more difficult, and it can go awry. And so that did happen a couple times, more than a couple times probably, when I was on the committee. And so the committee also meets out of sequence, so you don't have to meet just the 8 times a year. You can meet other times. One time recently when that happened was the pandemic, when, we had a meeting scheduled for Tuesday and Wednesday, but things were happening so quickly that we actually met on the Sunday, all day Sunday, and did everything on Sunday and announced before markets open on Sunday at 6. Asian markets open on Sunday at 6, and we wanted to be done before that. So it shows you how market events and world events can really scramble the calculus about actually how to run the meeting.
Yeah. So going back to sort of the pre-baking, as I call it, much of the research that you have written about that I mentioned earlier, I read all your papers, emphasizes the
insomnia.
Yeah.
We fixed that.
Yeah, no. I actually had ChatGPT read all of them, and they give me a nice summary. Please dumb this down for like 5th grade, and I did it well. It emphasizes this idea of policy regimes, and if you can explain to our audience what is a policy regime and why is it important to think about monetary policy in terms of regimes rather than a series of discrete decisions over time.
Yeah. So this comes out of the statistical side of the economics literature, what's called the econometrics literature, and there was some great work done in the 90s, which I picked up on about regimes in statistics. So what they're really talking about is you've got some variable and it has a mean and it has some variance and it bounces around like this around the mean. But in nonlinear econometrics or this regime econometrics, it would bounce around this mean for a while, and then it would switch up to this higher mean, and it would bounce around up there for a while, and then it would switch back to the lower level, or maybe to some other level that you hadn't seen in the past. So this started to be called regime switching, and it works great for certain types of problems in economics. And one that is that I often focus on is productivity growth, because productivity growth in the 1960s in the U.S. was very rapid, and so you were bouncing around a high mean. And then, after 1973, productivity started growing at a slower pace. All these papers were written about the productivity slowdown, blah, 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 and so you were bouncing around a lower mean productivity growth rate all the way through the 1980s, all the way into the 1990s. So the regime is the fact that it goes on for such a long time. It's not just the normal statistical bouncing around that you would otherwise see. And then in the 90s, a miracle happened, and Greenspan was on top of it, and he was very good on this. You bounced back up to the fast productivity growth, and stayed there for about 10 years in the U.S. So that's why the second half of the 1990s is considered a good analogy for what's happening today. If you have fast productivity growth, that's basically your most important variable. It means that real income for all of us is going up faster than it otherwise would. You're getting a lot of growth in GDP without inflation. That's what happened in the last half of the 1990s. And by the end of the 90s, lots of problems have been solved. Lots of wealth have been created. Unemployment went down to 3.8%, a previously unheard of low. So it matters a lot whether you're in the high productivity growth regime or whether you're in the low one. After 2005, we switched back to, statistically speaking, to this low growth regime. But now I'm hopeful that we're switching again, partly because of artificial intelligence and all the investment around that, to a high productivity growth regime, and we'll get the faster GDP growth again that we had in the second half of the 90s and into the later period. So hopefully we'll get that.
Yep. You mentioned COVID earlier, And you were early and vocal about the risk of inflation after the pandemic. And, obviously you saw there's all the PPP money out there. There's excess liquidity in the market. What signals convinced you that inflation would not be transitory? And then what lessons should policymakers draw from post-COVID-19 inflation surge?
Yeah, so I'll give you my take on the episode and see what you guys think. But here's how I want to think about the pandemic. So in economics, in macroeconomic history, there's a well-known formula for generating inflation. What is it? You go look at all these different places and times, and you look at when the nation got stuck in a war. And what happens in a war is that the society is upset, the enemy is attacking, they spend a lot of money, but they don't really have any future taxes that they're, that are going to back all that spending. So a lot of deficit spending. And then usually because of the war effort, they put pressure to say, let's keep interest rates low to help fund the war. So that formula generates inflation, all kinds of times and places, ancient times, medieval times, modern times, all of it. So the way to think about the pandemic is that it's like a war. It's not exactly like the World War II or something, but you're fighting a war against the virus. Society is very upset. People are dying. You want to do as much as you can to mitigate the situation. So the government starts spending, and how much do they spend? A third of GDP or something. All borrowed money without very much thought to where are the future taxes to pay all this debt back. And you put pressure on and the central bank went along. You're in a war, so yeah, we'll keep interest rates low to help with the war effort. So what do you get out of that? Well, the same thing that you got in all these other situations. You get some inflation. And I think we should have probably been more prepared that would be a likely outcome than we were. And so we got a lot of inflation because of that. When you say, well, how can you get rid of the inflation? You have to reverse that process. And my interpretation of 2022 is that's exactly what happened. So you get to 2022 and you're coming up on the midterm elections in late 2022, and markets are looking ahead. They see those elections coming, and politicians are looking ahead. They see the elections coming. So the Republicans are going to win that election. So what does that mean? It means that you're going to return to fiscal rectitude. You're going to have a divided Congress, so you aren't going to be able to spend at the rate that you were previously spending. That's exactly what happened. And the other thing that happened in 2022 is that the Fed, including me, my colleagues, also returned to monetary rectitude. So we said, hey, we can't have low interest rates with this much inflation. So we raised interest rates dramatically during 2022, including a sequence of 4 meetings in a row where the policy rate went up 75 basis points per meeting, unheard of fast rise in interest rates. So you took away the deficit spending and you took away the zero interest rates, and boom. Right when we did that, then inflation started coming down. And by the time you got into the second half of 2023, inflation had mostly gone away. Not entirely. We still got a little bit of inflation, but certainly got down to 3% based on that formula. So that's how I think about the inflation episode.
So going back to then a different crisis, back in 2008, you took the helm. You led the St. Louis Fed.
It wasn't my fault.
I know. You led the St. Louis Fed during an unusually volatile period in economic history. When you look back and you think about your position and your role, what stands out the most from that period and the Fed's role in helping manage that crisis?
Yeah, I mean, the global financial crisis unfortunately started in the U.S., in the heart of global financial markets. So it was really, that's maybe the first thing to keep in mind. I think also it started outside of the U.S. banking system. So the Fed often gets criticized for, hey, you were asleep at the wheel or something, not pursuing regulatory policy as aggressively as you should have going into that crisis. But that's not what happened. What happened was the non-bank financial sector, which was not regulated by the Fed, that's the place where the crisis originated, and specifically with the investment banks in the U.S. So many things happened, but I think you should, looking back on it, you should remember that it wasn't the regulated sector. It was the shadow banking sector, which was the source of the crisis. So the reaction to the global financial crisis in the U.S. was the Dodd-Frank Act, which kind of threw a lot of new regulation out there into the marketplace. But I would encourage all of you to, and I said this at the time, if you put heavy regulation on the regulated part, then what is going to happen is you're giving incentives for non-regulated entities to try to figure out how they can get around those regulations and how they can provide financial services without being a regulated market. That has happened like crazy since the Dodd-Frank Act was passed. And now you've got a regulated sector trying to compete with a Silicon Valley funded, and if you go out there to Silicon Valley, they'll talk about trying to rip off all the revenue structures that banks have. They're trying to figure out ways to get the lending done without calling it bank lending. You've got buy now, pay later, for instance. You can't call it credit. Don't call it credit because then it would be regulated. But let's do everything outside the regulatory perimeter. And so what's going to happen? And this has happened historically, it's that sector, the unregulated part of the financial sector, that will eventually be the cause of a future financial crisis. So this is why you can't get rid of financial crises, is because you try to put so much pressure on your regulated sector that you give incentives for firms to try to reinvent the same financial services outside the regulatory sector. So.
And this kind of like raises the long debated issue about acting too early versus acting too late. And, when it comes to all these like tech, the fintech, and now you hear talk about Bitcoin and stablecoin and all that. And so more often the federal government's response has been to let the technology develop. Like, we're not going to regulate it. We're going to see, because if you quash it too soon, like it stifles innovation.
We all love technology. We want the innovation to occur. So there's some merit to that argument, and but that pushes Silicon Valley's mantra is move fast and break things. And maybe that's a good mantra for many purposes, but maybe not for financial purposes, because you don't want to create a crisis of that magnitude.
Yeah. So, by the way, for the audience members, in about 15 minutes or so, we'll take questions from the audience to start thinking about any questions that you might have. And by the way, the questions are for him. You've been, let's talk about communication. I know you've been a strong advocate for clear communication, and I guess in your mind, like, why is central bank communication itself a powerful policy tool? What do you think about sort of transparency versus market sensitivity? Is there such a thing about being too transparent, and how the markets might react to that? But your thoughts in general about transparency and communication?
Yeah, I think there's just been growing awareness all during my career that, I guess Bernanke summed it up best. He said, central banking is 98% talk, 2% action. So, and why is this? It's because markets are forward-looking, and their expectations are very important for what's actually happening today. So you're always sitting there talking about, okay, what's going to happen over the next 6 months? What's going to happen over the next year? And how do I want to position myself today given those expectations? So when monetary policymakers are thinking about policy, they have to be thinking about this outlook, and they have to be communicating as best they can. Here's where we think the economy is going. Here's where we think inflation's going. Here's where we think policy is going. And of course, it's a fraught thing because you can't predict the economy all that accurately. You can do some things, and you can make reasonable forecasts, but shocks occur, big things happen, and you won't always be right. So it's that process. When you're talking about communication, it's that whole process of what are the markets thinking, what is the central bank thinking, and trying to get the whole thing in sync. That's what's going on every day. So people that are saying, oh, maybe the Fed should communicate less or not talk about the future, they haven't got the memo on how this works. So that's older thinking about how this works. We've done many things since the Greenspan era. Greenspan actually, if you read his book, The Age of Turbulence, so you can add that to your reading list.
Yeah, I'm going to add it right now because I have all the time in the world to read it.
So if you read that, he actually talks about being opaque. And he kind of came away thinking, well, the opacity was a good thing. But he got overwhelmed by the rest of the profession and said, well, what are you being opaque for? Why don't, he would famously use, cryptic phrases. And one of the jokes about Greenspan is that when he proposed to Andrea Mitchell, he had to propose 3 times because she didn't know what he was talking about. So his model in his mind, Volcker too, was that you should, never say anything. But they had the wrong idea about how this really works. Bernanke had the right idea. Why don't you just tell people what you're doing? It's like management 101. This is as far as we can tell you and far as we can anticipate the future. Here's where we think the economy is going. Here's where we think policy is going. Make your plans accordingly. And so that's what's going on ever since then. We got press conferences at every meeting. That was something I was an advocate of. And I also think that the committee, the big committee, 19 people on the committee, they should be communicating pretty much every day because every day new data is coming in or things are happening and markets are wondering, hey, is this going to change your policy? And so if you have one of your members out every day saying, that particular number won't influence policy that much, or that number is surprising to the upside, and maybe that would change policy a little bit. That's all part of this continuous communication that's going on, this continuous dance between the financial sector and the central bank. So that's why I like having a big committee, and I like having lots of communication from all the people on the committee pretty much continuously, and they're at events like this or all kinds of other things that they're doing all the time. If you don't do that, then you leave a vacuum. People aren't quite sure what the central bank is doing and what the central bank has in mind. When that happens, then other people start to fill in the narrative. And who are these other people? Well, they're big financial firms that have their own stake in the game. They're foreign countries that have their own stake in the game. They're politicians that have their own stake in the game. So you don't want to just seed the whole discussion. You want actual policymakers to be talking about, here's where I think policy is going, and then let all those other people talk about what they think should happen, which is all perfectly fine. But I don't think you want to just seed the whole territory for that group.
So are there risks, though, to financial markets being overly dependent on central bank signaling?
Well, you can do a bad job of giving signals. Things can go wrong, and they sometimes do. One place where things went sort of dramatically wrong was the so-called taper tantrum in 2013. So that was that the the committee had done the so-called quantitative easing program. This was bond buying at scale. And, when we got to the spring of 2013, Bernanke wanted to bring that to a close, but markets were expecting it to go on much longer. And so the June 2013 meeting was one where, very contentious meeting. That was one where there was a lot of volatility ahead of the meeting, and actually dissented at that meeting. I didn't think we were making a very good decision, but we basically told markets that we said we were going to continue all this bond buying, but we're really not going to do it. Wow. Global real interest rates up by 100 basis points and basically never came back down. So huge dramatic effect from kind of miscommunication and mishandling that whole episode.
You mentioned you dissented on that?
I dissented in June 2013. I thought we were being markets weren't ready for it, and I wasn't sure we should be doing it anyway based on what we had said earlier.
So how much dissent is there in meetings? I assume not every decision is unanimous, but talk to us a little bit about that push and pull.
Yeah, I mean, there's tremendous pressure to conform. And sometimes the easiest thing, as a committee member, the easiest thing to do is say, man, you guys got it. I won't say anything. But I felt like I didn't want to have, I wanted to have my own track record of when I was involved, here's what I thought, and here's where I thought we should go. And if I really disagreed, then I would dissent at the meeting. That only happened a couple times, but in certain occasions, the committee somehow gets off onto kind of the wrong path, and I think the role of its center is that you can pull them back to something that's more, possibly more sensible. If you do dissent, you're under a lot of pressure because you've got 18 other people that said something else. Why did you say whatever you said? So I think you have to be ready to say, I'm going to defend my views. Here's my view. 1, 2, 3, and defend what you said. And if it makes a lot of sense, you'll pick up support, I think, from outside the committee.
Okay. You may want to take a drink of water. We're going to get into some juicy stuff now. So the real reason why everybody came, this is a warm up, but obviously looking ahead, sort of current affairs, President Trump has made no secret he wants to replace Chairman Powell, and the Justice Department recently subpoenaed him and announced he's under investigation for the renovations at the Fed. And by the way, I looked up an article, and in response to the subpoenas, Powell said, which was uncharacteristic of him, usually like confronting this, he just kind of lays his head low and just keeps moving on. It says, this new threat, referring to the subpoenas, is not about my testimony last June or about the renovation of the Federal Reserve buildings. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president. Powell also vowed not to buckle, saying public service sometimes requires standing firm in the face of threats. So your thoughts on all of this, and why is independence of the Fed not just a governance issue, but an economic one too?
So it's a known fact. This is like something Jane Austen would write. It's a known fact that all politicians want low interest rates, and both sides of the aisle, they're the same all the time. They always think that low interest rates are going to help them get elected in the very near term, the next election. Now, right here, it's the midterm elections, but it could be a presidential election or whatever. And so they're always for lower interest rates. And if you allow that to run your monetary policy, you're going to get a lot of inflation. And ironically, people hate inflation. The voters actually hate inflation. but somehow this doesn't register in our political system. And so you get the idea that interest rates should always be low from politicians. So the idea is to insulate from that a little bit. You want to create a continuum where if you just left it up to the politician would just get the very lowest interest rates that they could, maybe even zero or something. And then they would get inflation from that, but that would be after the election. And so they would feel like that was a good deal. So to get better long-run policy, you want to insulate a little bit from that tendency. And that's what the Federal Reserve is designed to do. So it's not really independence. Independence sounds like they just got people off on an island by themselves. It's not really like that. But it's arm's length from this political, day-to-day political process. And that's why the Federal Reserve Act is so intricate and has the governors and it's got the New York Fed and all these bank presidents, and some of them are appointed and some of them aren't appointed, and boards of directors and all kinds of people involved. But that was deliberately designed to push the whole process out a little ways away from the day-to-day fighting inside D.C. over public policy. And I think it has been shown on the whole to get better policy than you would otherwise get. Now, some places, and so this has been copied all over the world, including the ECB, which is a treaty between countries in Europe. So there, it's an international organization really that makes policy for the Euro area. But all kinds of other countries have adopted independent central bank independence as a model, and when they did that, they got much better inflation outcomes than they otherwise would have gotten. So the story of the last 30 years is that around the world, inflation used to be really high and pretty variable, and it all as more and more central banks got central bank independence, inflation came down around the world. They set up inflation targets. Variability of inflation fell. Countries were much better at hitting these inflation targets, and you basically got low and stable inflation in many places around the world because of this. Some places bucked the trend. Some places said, oh, you guys are all full of baloney. We don't believe you. Let's name some of the countries that did that. Argentina, under the Kirchner government, 100% inflation. Venezuela, under the Maduro government, or the previous Maduro government, and before that, the Chavez.
I was going to say he's in New York.
Yeah, exactly. He's still running monarchy. 1,000% inflation. Turkey, Tayyip Erdogan, doesn't believe any of this, has fired 5 or 6 central bankers. Inflation's about 60% in Turkey. So I think, there are clear modern examples, and there are many, many historical examples of, places where you allowed the government to directly control monetary policy, and they handled that irresponsibly and created a lot of inflation. So that's where the idea comes from, that you should have this complicated machinery to run monetary policy that involves a lot of people and a lot of process, and it's not totally separate from the political process, but it's far enough away that you don't allow this direct control.
So, to your point earlier about sort of the structure and how it got insulated from the political arena, as I understand it, Chairman Powell's term as chair ends in May of this year, but then his term as a governor ends like a full year and a half away. 2 years.
Yeah.
2 years. And so one of the issues now surfacing on the news is, traditionally it's been customary for the longest period of time, as I understand it, that if your term as chair expires, then you leave shortly thereafter, and then the president appoints another governor, but
Yeah, so
there's rumor
I
he's
think
got.
what you saw a fortnight ago with Chair Powell's video statement was a change in tactics on his part and on the part of the Fed. So you're right that the standard procedure has been to lay low, and the incoming administration has strong views. They've been attacking the Fed, and he's been laying low, but he shifted tactics. So I'll just name a couple things that I think have changed the complexion of the argument here. One is that he called out the Department of Justice criminal investigation. The idea is that the chair somehow in congressional testimony misrepresented what was going on with the whole building arrangement over at the Federal Reserve. But if you understand how congressional testimony works, sure, your principal is saying things in front of the committee, but members of the committee can also request information later, and they do, and then long things are written, which is about this thick, answering all those questions. So I'm very skeptical that somewhere in all that documentation, all the questions of the committee were probably answered somehow, and everything that could be discussed was probably discussed. So the idea that there was some kind, for this testimony or for any testimony, the idea that there's some kind of misrepresentation there is a tall task to try to prove something like that, because there's so much information on the table. So that's why. So he said this is a pretext for attacking the Fed. He also did several other things. Moved up the reappointment of all the Fed presidents. They've all now been reappointed. So he took that issue off the table. He also, it was no accident that Senator Tillis made an announcement at the same time that Jay Powell did, saying that he wouldn't vote for anybody to go on the Fed right now. So Tillis is the marginal voter on the Senate Banking Committee. So if he decides to vote no on a Trump nominee, there isn't going to be anybody getting on the Fed anytime ever without his vote until he leaves the Senate. So, which is going to be soon. It's no accident that he is a retiring senator, because he can lead the Republican caucus without getting anyone else involved in the Republican caucus. He can lead the caucus and say, oh, well, I'm not going to vote for any of the nominees till this is fixed. So this is classic inside the Beltway politics. And as it stands today, this is a stalemate. There won't be anybody getting onto the board. There won't be any new chair. There won't be anything. So this is a stalemate. Now, the administration can come back and try to do other things. We'll see what they do next. But this shows one thing about Jay Powell, I would say, is that he comes from Washington, D.C., and he's been very good at cultivating support on both sides of the aisle, even in this highly politicized era. He knows everybody inside D.C., and he has worked hard at this, so he has resources to draw on to make this stalemate stick. So we'll see how this goes, but as it stands now, when he's done with his term, what will happen is there could be that there's no chair yet if this current situation holds, and he would just continue as chair. So I don't think that's quite dawned on financial markets exactly how this works. But the way it works is if you don't have a new chair, then the old chair just keeps staying. And
he's got 2 more years.
And there's no prospect of getting it through the banking committee without the Tillis vote. And there's no prospect of bringing anything straight to the Senate floor unless you're going to pull Democratic votes for that, which I don't think they're going to go along with. So this is classic Washington about how this works. So we'll see how now the Trump administration responds.
Great. So do we have any questions from the audience? I think we do.
Dean Bullard. We brought up earlier some of the politics involved with the Fed. The Supreme Court is currently trying to decide whether they will allow Trump to fire Lisa Cook. Does it worry you at all that being allowed to fire at will a Federal Reserve governor could diminish the interest of quality people taking that position at all? Or is it nothing to really worry about?
Yeah, no, I think that's a concern. I didn't even mention about other elements of the Federal Reserve Act, that more intricacy in the Federal Reserve Act. But one of the features is 14-year terms for governors, and that has whittled away, I would say, over the years. But originally, it was envisioned as a plum job that you get paid a lot and you would be treated well and you would stay in the job for 14 years. And you couldn't be fired except for cause, which I think most people would say is, gross negligence. The Supreme Court discussion yesterday or the day before was that, there has to be some charge that meets this gross negligence standard. So I think that's where they're going to come out. And there also has to be some due process. You can't just have a partisan on one side or the other side, and both sides will do this. We'll just say, oh, so-and-so, committed this crime or whatever, or and therefore shouldn't be allowed to serve. And if you don't have some due process around that, then it does become just fire at will. And the justices did say that in their questioning. So I think the court is going to find a way to probably put a better definition around what it means firing for cause. Now that it's come up, it probably is a good thing to define that more carefully. One thing I would say about this is if you look at judges, and I'm not an expert on this, and there probably are experts here in the audience, but judges, they have to be impeached if you want to take the judge off the bench, and so that goes through the Senate, and so there you have, and that takes 2/3 vote, and so there I kind of like that because that's then the political process does have a way to remove somebody that, really is, not performing or making nutty decisions or whatever. You would have a way to bring that up, make the charges,
Make your case. Yeah.
do it through the Senate and get your 2/3 vote, and then you can kick the person out. I kind of like that because what we have now for the Fed is too vague. And historically, people thought, okay, well, that means you have to be drinking on the job or something, but this would set a standard that would meet up with where it is for federal judges.
Great.
Right here.
All
Hi.
right.
Thank you for your time. I'm wondering if you can speak about the deficit and how that comes into monetary policy when the goal is to maintain price stability and highest employment, but yet we have a growing deficit and the interest payment on that for the country continues to become an increasing burden. How does that inform the look for the next 6 months and into our future?
Yeah, so a couple things on U.S. debt and deficits. They're too high. So unfortunately, I think both parties have retreated from fiscal rectitude as a way to get elected. There was a time when you could campaign and win, I would say, as a fiscal conservative. You had people in both parties that were fiscal conservatives, and that has pretty much evaporated. So that's something we should all be thinking about. What does that mean for the future of the country? So the U.S. Debt to GDP ratio is very high and growing. However, there are a couple of mitigating factors right now. So there's just a tad of a silver lining around a very gloomy story, which is one is that economic growth will help us enormously, and I'm bullish on U.S. economic growth. I do think the administration is a pro-growth administration. They think in terms of economic growth. They do lots of things that contribute to economic growth. I think they should play that up even more than they do. But if we do get rapid growth and we do get a higher productivity growth regime here, that's going to help us a lot. So that's one thing that's keeping markets at bay, I think, a little bit on this issue. And then the other thing is that the tariff revenue has turned out to be substantial. And so one way to think about that is that through the back door, a Republican administration has found a way to raise taxes. They wouldn't actually vote for raising taxes, but because of the whole tariff thing and the substantial nature of the tariffs that we're talking about, you've got a lot of revenue coming in. So that's actually mitigating a little bit the problems that would otherwise be really out of control are only sort of, not quite as badly out of control.
Hey, at least credit cards are going to be capped at 10%. Do we have another question? Yeah. Okay.
Do you have any innovative ideas on alternatives to the Frank Dodd type of regulations that would not overly regulate the regulated sector, but would still mitigate the negative impact of the risky actions of the unregulated sector?
Yeah, I think it's that's an excellent question, and I wish we would think more about what the regulatory framework should be. That was debated a lot around the 2010 time period when Dodd-Frank was passed. I said at the time that there were provisions that weren't going to work in the medium term and long run, but you just can't get Congress to think about things unless there's a crisis, and so I think, unfortunately, that's the reality of the situation. So I guess the answer is no. I don't have great.
I think he wrote about it before. He just doesn't remember.
I don't. I mean, Ideally, you'd like to have more flexible regulatory bodies that would think carefully about, what's happening in all these areas. Stablecoin is one area that does get attention these days, so that's one that's is being looked at. But the overwhelming tendency is just to maintain the status quo until there's a crisis, and then react to the crisis. So unfortunately, that's the pattern.
Great.
We've got time for one final question here.
Good evening. Thank you both for being here. My question, I don't know if this is a nuts and bolts question or a philosophical question, but you addressed the statistical regimes earlier, and I was curious about any sort of patterns of precedents that can predict those. Or does it get to the expediency thing that you mentioned regarding politics? What are the inputs that lead to those sorts of things? Are they recognizable patterns?
I'm sorry, I couldn't understand this question.
The statistical regimes you mentioned earlier?
Yeah.
The regime.
Do you see precedents that you can almost predict what those outcomes are going to be?
Predict the regime.
Essentially, yes.
Yeah.
Thank you.
And the answer to that is no. So the idea is that you get into these long periods when, we just had one. Here's a different one. Very low global nominal interest rates. If the bankers in the room, they're very familiar with the 2009 to 2019 period, and gosh, so many rates all around the world were actually negative. Very weird. Went on for a very long time. And I think the question in 2019 was really, how long is this going to go on? And it looked like Europe was becoming like Japan, and Japan has had low nominal interest rates forever, and so on. Then you got the pandemic came along, boom. And the pandemic, of course, is a disease thing, but it affects the economy and how the economy worked and everything. And that jolted us out. Now we seem to be in a much higher nominal interest rate regime around the world. All the negative rates have gone away. You had a lot of inflation. You had it's a completely different era. And could you have predicted that you're going to switch from one to the other? No. When you needed a really big event, and the really big event came along, and now you're in a new regime. So statistically speaking, that's the way you would talk about it. You can't really model, when the switch is going to occur. But when it does occur, then life is very different when you're living in this era versus when you're living in this era. So I hope that's helpful.